What's going on, everybody? Michael and Coco here, back from a wonderful vacation. Thanks for everyone's patience out there. You're watching the Daily Stock Market Brief. This is the show that I do Monday through Friday. We use technical analysis to really get a good idea as to where the stock market might be headed next. In today's video, we're going to be doing the bearish case for a potential market correction. Now, yesterday's video was the bullish case, and now you might be thinking, well, why are you flipping back and forth? Robert Kiyosaki says it best. Every coin has three sides: heads, tails, and the edge. The way to become a very successful investor, trader, etc., is to be able to stand on the edge. What that means is being unbiased and looking and understanding both sides of the equation. So in yesterday's video, we went over the bullish case for a move to the upside. In today's video, we're going to be looking at it through a more bearish lens to really understand, hey, what are the market risks at play right now? So without further ado, and before Coco falls asleep, let's go ahead and get into today's show. All right, welcome back. We're going to start here with the indices, but let me just add on really quick. If this is the type of shows that you do want to watch, make sure you hit that subscribe and like button. It is greatly appreciated. This channel has grown tremendously because of people like you helping me out, helping me spread the word, and just really understanding what's going on in the overall markets here. We're going to start off looking at the S&P 500 on the weekly time frame. Remember, we're looking at this from a bearish perspective. So what looks interesting here? Well, first off, we already know about this broadening wedge pattern. Some people call it a megaphone pattern, whatever, okay? But let's look at the current price action and then some of the indicators alongside of it. What I see here is just this one very, very big green weekly candle. Okay, that was bullish after a big red candle. So kind of this reversal type look. Now we're forming what seems to be somewhat of a blow-off top type candle. Now, it has not been confirmed or anything, but you can see that the week went above the upper trend line, way below to close the gap because it opened there, and then closed where the week basically opened up at, being around 2.16% up. Now, keep in mind, the trend line is up here, the upper Bollinger Band is here, and it got rejected. Now, the bulls have control right now, but from a bearish perspective, it looks like this kind of candle formation can very well get some confirmation to the downside and could become a evening star. You can consider this a shooting star or a shooting doji. Whatever the case is, the psychology or whatever the name is, the psychology is most important. And from my perspective here, we came in, filled the gap, but also we went above the trend line, and then we came back below it. So we're in the upper range of resistance and multiple confluences, okay? So that is one thing from a bearish perspective. Hey, it's probably not the best idea to go long right here. Now, maybe we get a gap up on Monday. That would actually, which we get into the other charts here, you'll notice why I think about shorting the market on a gap up going into next week. Now, I'm not confirming that yet, and that's not my specific move until we see what takes place, but I'll get a little bit more into it. The next thing on the weekly time frame is the bearish divergences both in the RSI and the MACD. Obviously, the RSI is not fully oversold and it can reach into overbought territory, but what we're seeing right now is a reading from a high here to a higher high, and then from a high here to a lower high. So that is a negative divergence both in the RSI and in the MACD. On the daily time frame, this will show you more really what was going on in the week. Most of the week's move, well, I should say a couple of weeks, since basically November, right? So a couple of weeks has been moved through the aftermarket's hours. So these gray boxes are all gap ups. And what happens when we have these erratic gap ups and kind of just illiquid type choppy market during the cash session? Well, they typically get filled. Now, that's not always the case, okay? I've gotten a lot of questions, well, why are the gaps important? Well, the gaps can help us kind of determine, one, what's kind of going on in the market from a liquidity standpoint. When we're getting huge gap ups in the overnight sessions like we're seeing here, that means, you got to look at the historical technical analysis or technical charts to really determine, hey, what is taking place when we get these up? And typically, it's one, short coverings, so it could be a short squeeze, and then you have cash buyers buying into that momentum, and they typically can get filled quite rapidly. As we saw here in August, these gaps going up, and then they got filled quite rapidly. The same thing here, through the middle of October, and then they got filled very rapidly. Now we're seeing even a more aggressive push to the upside, creating more gaps, which means there's just a lot of air pockets. A lot of this was made in the afternight session. So it's just something to consider from a bearish perspective. We have another gap up from today. We did reconnect just the other day to the 5 EMA, and we're still above the trend line. So the bulls are technically in control here. The VIX down here, you can see, this is an inverted scale of the VIX, so it just helps me kind of visualize the chart a little bit better. But it's a bull flag taking place, which means if it starts breaking out to the upside, in theory, that's actually the VIX going lower because it's at 20, 25 or 20. It's basically trading around 25 to 22, which is very interesting level of volatility at this high point in the market. So the VIX, if you just look at this red box looking back, it's in an area of resistance. And we've already mapped out this flag, and we'll look at it again here in the near future. But then there's all these air pockets beneath us, which is just a cause for concern. And we're also getting potentially overextended on the daily Bollinger Band here as well. Here is the 15-minute time frame. Now you're probably like, whoa, I can't even see the candles. That's totally fine. I just want to show you that right now we're kind of overbought here on the S&P 500. We created a bear flag. We broke out of it. Now we're kind of seeing this rising wedge here, similar type pattern again. And we have this gap right beneath us. We had that inverse head and shoulders that we talked about quite some while ago. And then when we started busting out of that, it was really started seeing some aggressive moves to the upside. But what's interesting here is you can see all the gaps on the VIX 15-minute time frame. And this is, by the way, not inverted this time. And then all the gaps on the way up to where we currently stand. So it's going to be interesting to see. We might get that spike in volatility here. As you can see, the VIX is running to its area of support. So if we start hitting back up to the upper portion of the channel, we might be filling some gaps on the way down. Or if we even break out, we might be filling even more gaps on the way down. Now let's take a look at the Dow Jones. This is the reason why I'm just going over this S&P 500 and the Dow Jones today. And the reason why is because I see these as good opportunities to potentially short from a bearish perspective. Here's the weekly time frame. Very similar candle setup, right? Huge week. And then we had this monster gap up, which I didn't actually put in the gap, which it didn't get filled either, into a doji type candle, which means, hey, this is indecision taking place. And where is it taking indecision at? Upper Bollinger Band and the previous all-time market high. The Dow Jones did reach just about to 30,000. And a while back, probably around this range, I remember talking about the potential for the Dow Jones to get to 30,000. So we didn't quite reach it, but potentially if we see a big gap up on Monday into this range, that could set us up for a good short opportunity because we're going into a major area of resistance, and then we have this gap below us. And on top of all of that, we're disconnected from the 5 EMA quite significantly here on the weekly time frame. Here is the Dow Jones on the daily time frame. You can now see very similar to the S&P 500. We were trading in this channel. We broke out of the channel. By how? Well, the aftermarket session on this gigantic gap. And below us is just a bunch of air pockets as well. Very similar to what we saw in the S&P 500. I'm not going to reiterate all of that, but very similar. Then we see this extended candle over here above the Bollinger Band. We kind of got disconnected a little bit, pushed back into it, reconnected to the 5 EMA, and then had a decent day today at 1.37%. So overall, everything looks strong and bullish. If you look at this chart, people are probably getting really excited because of these huge moves to the upside. But really what's going on behind the scenes is this market is being driven after hours, not really done by the cash markets, which is a little bit concerning to me. Now, here is the Dow Jones on the 15-minute time frame, so you can just get a better idea of all these just gaps zoomed in, boom, 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 to the upside, into that overbought territory. We had a falling wedge, or you can even call this a bull flag, whatever, and we broke out to the upside. And this is good, but why I'm considering a potential short of this is because of the fact if we gap up on Monday, we're going to be running into some resistance and we'll be pushing ourselves into overextended territory. So it could set itself up for a very good trade early on in the week. Now, Monday might gap open and it might run higher, but then it might be cause for that whole Tuesday, the turnaround Tuesday. All right, we're going to get into some indicators now. I'm just trying to run through these, and keep in mind, once again, this is the bearish case. So if you think that I'm being extremely bearish, well, the point of that is simply because, well, we're looking at through the bearish lens. If you want to see a more bullish case scenario, please just go to my previous video and you can watch that as well. We're looking at both sides here. The first indicator I want to show you is the S&P 500, okay, on the daily time frame, and then below us is the SPX A50R and A200R. What are those, Mike? Well, it's the percentage of stocks in the S&P 500 above the 200 period moving average and above the 50 period moving average. This can help us determine breadth of the market, which is very important to kind of understand. Now, what am I doing here with these indicators? What are these blue lines and red lines? First off, let me just really quickly go over where we're at right now on both the 50 and the 200. So the 200 is basically saying 85.97% of the stocks in the S&P 500 are above the 200 period moving average. And then down below us is 85% of the stocks are above the 50-day period moving average. Okay, so in easy context, what does that mean? People are very, very bullish right now. So why is that important? Well, from a contrarian perspective, a contrarian opinion, it's based on the premise that when the majority of people agree on anything, they're generally wrong at extreme levels, okay? So why is that important? Well, first off, we're both at extremes right here on these two levels, and we're getting to some other indicators, which tells me that, hey, we could very well be in the wrong right now and be in the situation for a pullback. Now, you might be saying, well, show me proof. Okay, well, this blue horizontal line, as you can see, we're above 80% here on the 200 indicator, and then on the 50 period moving average indicator, we're above 80 as well, right around 84, 85 at both of them, okay? Then you scroll back at the last time both of the indicators reached these levels together. The last time was right here in early 2020 to February, and that was where the big stock crash happened. Or, I guess I would consider it just a flash crash. That only lasted a few weeks until we're back up, basically. Okay, in 2018, we reached this level, and we reached this level right here on both the 50 and the 200, and then we saw that hit to the downside. Right here in early 2017, boom, we breached those levels, and we saw a flash to the downside. Then same right here in 2016, a little bit mid to late 2016, both hit those extremes, and then we saw the move to the downside. So is this, am I saying that, hey, no matter what, this is going to mean that the market's going to crash down? Well, I'm not saying that. What I am saying is pay attention to the aggressive swings to very, very bullish momentum on both of them and what happened in the past when you saw those aggressive moves to the upside. It's something to prepare yourself for, because right now, when we're moving into these extreme levels based on a contrarian point of view, when they're all overbought, the majority are in agreement, which means that there's likely less buyers out there to push the market higher. So, 3,600 on the S&P 500 is looking pretty strong as a level of resistance, including when you just look back to the history on this previous peak right here, and then you have these two running into it. It's just a cause for concern. All right, so this chart right here, first we're looking at the S&P 500 and the two indicators below it. You may be familiar with this. What this is the AAII, the American Association of Individual Investors. They basically poll their memberships to determine if they're bullish, bearish, neutral, and investors typically tend to change their minds quickly. So I'm looking at this on a weekly time frame, and what we want to do here, like I've already stated, is look for extremes to take place. Now, this is the bulls in the green, the bears are in the red, and then the bulls to the bears ratio. We're just taking the bulls sentiment over the bears sentiment. This is a sentiment indicator. We're determining what the sentiment of the market is. So when we reach extremes, it's going to tell us, hey, let's take a contrarian point of view. And what I want to point out here is the big weekly change. We're now on this. First off, I'll just look at the ratio is above 2. And the last time it was really at those levels was right before 2020 in December, before that market turned down. So, and then we also had it right over here in 2018 when we saw that market turn down. We had it right here. So, and right here is June or July. So we went up a little bit higher and then clashed down a little bit right here. It reached above 2.0. And that really just kind of went up and then right back down. when you look at the American Association of Investors poll from the bulls perspective, I'm just say AAII, it's way easier. Look at the big weekly change here, how it shot up right around the 60 marker, and the last time it was really there was here in 2018 when we saw that big pull to the downside. So the sentiment here is extremely bullish. So from a contrarian point of view and looking at a candlestick chart like this, as we've already discussed, taking a contrarian point of view here actually makes a little bit of sense to me. Here is the NIMO. You're probably familiar with this chart. I've been showing this often. 2018 looks like 2020. We're forming this W, reaching a new high, but we're doing so on a bearish divergence taking place currently. We're at 42.48. As you can see, we went down, up, down, up. Here is the down, up action. It was followed by a sharp decline on negative breadth. Now, there's a couple things that can go awry here. First off, we have the bearish divergence. So then we might start seeing it sink. So that is a bearish type view. And we have the possibility, if it still goes higher, we have a double top here, which we've seen a double bottom here when it reached minus 80 at those extreme levels. And when it did that, we saw the run up. So if we're going to get a double top here, maybe we're going to see the run down to about, maybe 3,300 to 3,200. If it starts going lower, we're going to be looking at 3,000 to 3,100. The last indicator is the Pring bottom Fisher. Now, why is this? This first off is an indicator that I like using for finding market bottoms. And really when both lines cross below the green line and then you see the blue line cross above the green line, which is the moving average, it indicates that, hey, the market could be set for a turnaround. The only time on this chart where it did that under the green line was right here. That was that March bottom, maybe just a little bit more. And then we really started finding our momentum to the upside. We crossed right here. That was right around this inverse head and shoulders. And then we saw that squeeze to the upside, creating this symmetrical type pattern. Now we're seeing that crossover again take place. They're below the black line, not the green line, right? And we saw some move to the upside today. What this doesn't do, it does not find how high the market can go. Why is that important? Well, if you pay attention to where this crossover took place, it's happened here before, right? And if you just look up, yeah, we still continued to go up and that was nice. But it also happened right here in February, all right? And it crossed over and then quickly declined into that March crash. So yeah, we might go up a little bit more, but keep in mind, this indicator I used on the bullish perspective. Now I want to tell you the bearish perspective of it. Yes, it could be very good at finding a market short-term bottom or long-term bottom potentially. However, it doesn't show you how high you can really go. So we're crossing over right now. Maybe we go break out and make all these new highs. Maybe this symmetrical triangle, came out, back tested, now we're going to go shoot up higher. However, keep in mind the context of the chart. Okay, it's happened here before, moving down. When we layer this on with the other sentiment indicators, the breadth indicators, and the candlestick charts, what's this all telling us? Well, from a bearish perspective, things can get ugly very quick, especially when we take into consideration all of these huge gap ups. All right, everybody, that's all I have for you on today's daily market brief. Hope everyone has a wonderful weekend. I plan on putting out a weekly scan. I'm a little hesitant for it, to be quite honest, just because how erratic the market has been going. So I'm still in the kind of decision mode right there. If I don't do that, I plan on doing some analysis around the rotation out of these tech stocks, what I've been noticing, and kind of getting into more some intermarket analysis type stuff like gold, silver, etc., etc. So be on the lookout. Like I said, if you haven't done so already, please subscribe to the channel, smash that like. It's greatly appreciated. I'll see y'all later.